Hi, everyone. Thank you for joining us for our June market update. I'm Valerie Leonard, CEO and financial advisor at EverThrive Financial Group. Each month, I share market and economic thoughts to help investors make informed decisions. And there's a lot of information clutter out there. So, my goal each month is to help cut out the clutter so that you can get a comprehensive and balanced update in just a few minutes of time. So, before jumping into my thoughts regarding the economy and the stock market today, I want to address how tired most Americans are of the ups and downs of the market and the economy, and also the concerning headline news that we see so often. Thankfully, we've seen the market make a push higher over the last 90 days or so, but the majority of our clients still have a feeling of unease over what might be the next shoe to drop, and that could potentially send the markets lower. They're afraid that the worst still isn't necessarily behind us yet. And so, on the other hand, I have more aggressive clients who tend to feel a sense of FOMO or fear of missing out, and they've wanted to jump into the markets full steam ahead. So I'm going to address my potential outlook for what may be coming next. But before I do, I want to give you 5 strategies for fighting fatigue over investment volatility or just rising costs that we've all experienced that are driven by inflation, fatigue over recession talk, or really any investor consideration that's wearing you out for that matter. The ups and downs of the past 20 months have definitely challenged us all from an emotional perspective. And the biggest concern I have when I see investors getting fatigued is when they start making emotional decisions, which can have significantly a negative impact on their financial future. I really want you to get your facts straight since emotions can cloud our judgment and take actual events out of context. That old saying about not being able to see the forest for the trees, well, that really does apply here. And when you're in the midst of uncertainty, it's best to take a step back and get context before you make any decisions. So, the first strategy that I have for you today to help you overcome stock market fatigue is to know that there's a difference, a really a big difference between a true bear market and what may seem like a bear market. So, as many of you know, the definition of a bear market is a 20% decline from a recent high. And this chart here on your screen shows bear markets going back to 1929. So, there's a few things to note here. One is how few total bear markets there actually have been over the past almost 100 years. There's only been 15 since 1929, and some of them have just lasted a month or two. And another key point to understand is that the duration of bear markets tends to be a little bit different than what most people think. I know it may seem like we've been in a bear market off and on since March of 2020, but the reality is that the S&P 500 was technically only in a bear market for 1 month in 2020 and just over 5 months in 2022 before the S&P 500's losses started to improve to a point where the market wasn't down a full 20% any longer. Of course, no one wants to lose money. Nobody likes their accounts to be down, but improvements in markets tend to be missed by investors who pull out of the market too early, which means that they don't get to participate in all of the up days in the market. And that brings us really to another important point for any investor to remember. The best and the worst days in the market tend to be clumped together. And this is one reason it's almost impossible to try to time the market. This chart shows the S&P 500 since 1980 with the 51 best days marked in green. I know it's a little hard to see here, so what I did is I circled some of the market drops, and you'll notice a lot of green. And the green illustrates the best days in these circles. So the arrow you see points to the bear market that began in October 2007 and lasted 17 months. But it's also part of the chart with a big cluster of the best performing days. So, to sum up strategy number 2, staying invested in a diversified portfolio during market volatility really means you have potentially more opportunities to benefit from the best market days. Strategy number 3, as I mentioned earlier in the video, is to avoid making emotional decisions. Here's another look at what can happen when people pull out money in a panic. This chart shows the S&P 500, and it shows the impact of missing the 25 strongest days in the market going back to 1990. So the black line shows the growth trajectory of staying invested, not making any changes to your investments. The red line shows a portfolio that missed the 25 best days. And then the gray line represents 5-year treasury notes, which are ultra conservative, as a comparison to illustrate really a more conservative fixed income strategy. So, in summary, as this chart shows, missing the best days in the market yielded no better return than staying in conservative treasury bonds. Now, let's talk about strategy number 4 for managing volatility fatigue. I want you to keep in mind that volatility is actually normal and this is to be expected. So, this chart looks really busy, but it shows month by month volatility patterns in the S&P 500 going back to 1951 to the start of 2023. So, I sort of like to think of this chart as a measurement of fear in the markets. And when the red line spikes, that means investors are very concerned about immediate risks. And when the red line falls, that shows that investors are more complacent and aren't as much concerned about immediate risk. So I circled one area towards the right here. That's when we saw, in the mid 2000s, market volatility was kind of unusually low, and people got used to calmer markets with fewer swings and were less mentally prepared for the more erratic swings in the market the next decade. And across 70 years of history, you can see, regardless of presidential cycles or economic conditions or even world events, there were always peaks and there were always valleys, which were driven by fear. So, strategy number 5 to help you manage your fatigue really centers around your employer sponsored retirement accounts. So, for many Americans, your 401k may be where the majority of your investments are held. And the Employee Benefits Research Institute studied the effects of the housing crisis in 2007 all the way through 2011. And they studied the effects on 401k account balances and the resulting recovery by each age group. Of course, the longer your time frame until retirement, the more time you have to regain losses. But what this chart shows is that between 2007 and 2011, every single age group had net gains in that 4-year period, despite losses upwards of 30% in 2007 and 2008. So the red line is 2008, the yellow is 2009, and the green line is the cumulative investment performance result. So the takeaway from this chart and strategy number 5 is to stay the course in your 401k accounts, especially if you are years away from retirement. And for those of you that are closer to retirement, don't forget you won't likely need to pull all of your money out on day 1 of retirement. This means going from a more aggressive to a more conservative investment strategy abruptly may not be prudent. Of course, every investor situation is different. So we always say meet with a qualified investment or financial professional before making decisions so that your situation can be evaluated more closely. But we work closely with our 401k plan sponsors and their employees to make sure that they have the information that they need to make smart decisions about their 401k investments. So reach out if you're nervous about your 401k account so that we can help you review your options. Now, here's a quick recap of the 5 strategies. So, number 1, bear markets and volatility tend to feel longer really than they actually are. So, be careful not to position your investments in a way where you may miss out on potential upside. Remember, the best and the worst days often clump together. Avoid making emotional decisions. Look at volatility historically and understand that it's normal, and consider staying invested in 401k accounts, especially when time is on your side from a retirement perspective. We've covered these 5 investor strategies today, but no amount of charts will help if your investments are misaligned with your actual tolerance for taking risk. So, to get a new or updated risk assessment that will assign you a risk number and tell us how you should potentially be invested, we have a QR code on the screen that you can scan here to get started. Just pause your video player to scan the code, and we'll contact you with the results once you take the assessment to compare your risk number to how your investments are actually positioned today. Now, on to this month's edition of what we're watching in the market and in the economy, and a quick update on market news. The past few weeks, the financial health of the consumer has continued to decline, meaning savings rates are dropping and the ability for consumers to repay debts is more at risk. The latest data from first quarter of this year shows credit card balances grew at the fastest pace we've seen in 20 years, while interest rates on that debt continues to remain at multi-decade highs. Also, this month is the first month credit card companies have reported that people are no longer paying down their debts. We're seeing delinquencies on credit card accounts increase. And we're also watching the labor market since weekly hours worked is also down at the same time that productivity at work is also declining. Credit deterioration also continues to be a concern because bank lending has tightened as banks aren't lending at the same rate they once were. And it's important to watch credit availability because it may be a leading indicator that leads to slowing demand and slower hiring by businesses. So, we're also watching the stress on commercial mortgage risk, especially since banks aren't lending like they were. Each week, the lending levels are declining. So, next, we look at corporate earnings, and those declined by 3.07% in the first quarter of this year. And while this beat expectations technically, it's the second quarter of decline in a row. Also, nearshoring is having an economic impact. If you haven't heard the term nearshoring in the past, just know that it's a shift in manufacturing and distribution where companies move their production and their manufacturing closer to their customers. And there are pros and cons of this shift, but this typically is a long process that doesn't happen overnight. And it's a trend that will likely continue for years to come. Generally, this means that companies will face higher prices, and those prices tend to get passed on to consumers. So, this could mean that inflation will remain elevated for longer. I'll be posting more on this in an upcoming video. Also, I have to acknowledge all this AI buzz that everybody's talking about. I'm getting lots of questions about AI. Yes, it's affecting some industries like copywriting and technology, research and design, but it's being tossed around as a buzzword in financial services, just like the crypto craze a few years back. So AI is certainly something to watch, but don't get caught up in all the hype. Hype is what causes bubbles, and bubbles are always unwound eventually. I will say that I look at AI sort of like a machine. Just like the invention of the car, AI can help us go places faster. And people were concerned about the safety of cars when they first entered the scene, and we're still concerned about safety today. But we still have the option to walk if we don't want to get in a car. And, if we don't want to get on board, then that car, may not be an option for us. However, most of us choose to take the risk and drive a car every single day because if we choose to walk, we will get left behind. And the world is changing quickly. So it's worth educating yourself. Just don't allow all the buzz about AI to cloud your judgment from an investment perspective because so much of the AI craze is still speculative. Thank you to those of you who have subscribed to our YouTube channel. I have some new videos I'll be posting soon, including some investor quick tips and deep dives that will help you stay in the know in between the longer videos that I record each month. So be sure to subscribe if you haven't already so that you don't miss this important information. And thank you for joining me today. As always, reach out with any questions, and I will see you soon.